everyone. I'm David Darst, here to give you a recap of the month of March. It was following normal procedure of March coming in like a lion and maybe going out like a lamb, but so far it's continued to act like a lion. You had a bunch of things take place during the month. First of all, the Federal Reserve met in the middle of the month and decided to leave interest rates unchanged. Chair Powell, not only in the FOMC meeting of the Federal Open Market Committee, he also in congressional commentary and other news conferences basically said that business confidence and consumer confidence have been weak. However, the hard data, such as retail sales and employment, have been relatively solid. The Michigan consumer sentiment at mid-month fell 11%. To 57.9 versus 64.7. That is goes all the way back to March of 2021, 4 years ago, when you've been down that low. Also, for most of the month, the American Association of Individual Investors bearish rating was 58, 59, 57, 61. It's very rare to have 4 weeks in a row of such extreme bearish readings. The long-term average for bearish is 31%. So, and we'll get to why in a moment. You had many companies, Federal Express, Nike, Walmart, okay, Lennar, which is a big the second largest home builder by number and the largest home builder in the United States by revenues, all of them giving cautious or else lowering corporate earnings guidance. Inflation expectations as of mid-month for March, 4.9% is the one-year forward outlook. Versus February, 4.3%. And you may recall the last time we visited together, that had jumped from 3.3%. So there's been a significant increase in inflation expectations on the part of consumers. You also had the continued news flow relating to DeepSeek, and now we have Alibaba, and we have Tencent, two additional Chinese firms that have entered this artificial intelligence light business model, which has put pressure, as you know, on the artificial intelligence complex. And then, of course, now the big news was, of course, all of the talk, the rhetoric, the actions on tariffs and a possible threat of a trade war. As the month ended, you had President Trump imposing tariffs on automobiles even before the April 2nd Liberation Day. You had continued layoffs in parts of government, which was this Department of Government Efficiency, DOGE, and, of course, international relations with all of the talk about Europe, talk about Ukraine, the telephone call between the president and Vladimir Putin. So this was a lot of things causing uncertainty, and public markets do not like uncertainty. That's one of the reasons we've focused, as you know, on alternative investments, since they're subject to less volatility. Yes, the valuations may fluctuate, but you're not hearing this and causing anxiety, angst, and perhaps improper portfolio movement. The government shutdown, a positive thing, was avoided by a vote of 54 to 46. They had a number of Democrats decided to support the Republican effort to keep the government open through late September. The February jobs, they were announced at the beginning of this past month of March. 151,000, unemployment, 4.1%. Average hourly earnings year over year up 4%. You have these flash purchasing managers indices. This is manufacturing and this is services. Services was 54.3 versus 51. So services doing just fine. Manufacturing, however, slipped back into contraction territory Last month, it was 52.7, now 49.8. Retail sales were up 0.2%, down 1.2% year over year. And the control group, down 1.2% the previous month. The control group, which basically takes out food, energy, and building materials, the control group was up 1% versus being down 1% the previous month. So, as Chair Powell said, pretty good on the jobs, pretty good on retail sales so far. Lead indicators, no. They've been down for 30 of the last 32 months. In the month of February, which was reported earlier this month in March, minus 0.3%. That's after minus 0.2% in January. You had late in the month, the last week of the month, you had the second revision of the fourth quarter GDP, and that came in at 2.4% versus 2.3% earlier. And, of course, the European Central Bank cut interest rates 25 basis points to 2.5%, and the Fed, as I mentioned a minute ago, left interest rates unchanged at 425 to 450. Now, all of this basically created a month after the January month was up 2.7%. We basically came out with all of this euphoric beginning to the year. February, it fell 1.4%. And as very late in the month, down 4.4% for the month of March. So March did not turn out well on the S&P 500. Year to date, down 2.6%. NASDAQ, even worse. NASDAQ, minus 5.5% for the month, minus 7.8% year to date. The banks, down 4.5%. And down 7.4% for the year. We do like the banks. They are basically much less subject to tariffs. You have a more bank-friendly regulatory framework evolving. We just haven't had the M&A and IPO activity that helps the banks. And so that's why they basically churned. They didn't do much. They're down 2.7% year to date. Europe, with the United States down 2.6% year to date through the end of March. Europe is up 10%. And look, Germany, Italy, they're up 14% thus far this year. Switzerland, for example, that's up 11%. So you've had this big flow of capital into Europe. A lot of reasons. People being turned off by some of the political developments in the United States, as well as the expectation of much greater spending as Europe has been told to perhaps raise money and continue investing not only in defense but in other aspects of their economies. The two-year Treasury closed at 397. It was down 2 basis points. It was 399 a month ago, 397. And year to date, that's down 28 basis points. So that's indicating expectations of the Fed eventually cutting interest rates, which we'll come to in a second. The 10-year, which is more reflective of the inflation and the economy, the 10-year for the month was up 14 basis points, okay? That's basically reflecting some of these inflation expectations, the worry that maybe inflation with the tariffs, inflation going to be higher. That was the reaction right after this announcement late in the month. I think about Friday the 28th, okay, a few days ago of March, with this imposition of the automobile tariffs. Everybody instantly believes that that's going to raise the prices of automobiles. The 10-year, which closed at 438, is down 20 basis points. So you want this 10-year yield to be somewhere in the range of 410 to 440. If it starts to get down towards 4, that means there's worries about a recession. If it starts to get up towards 5, that means there's worries about inflation. So this is the sweet spot where you really want to remain in this 410 to 440 on the 10-year. Oil was basically pretty flat for the month. It was down 3.8% back in February. For the month, it was basically pretty flat. Oil $69.92. There's a lot of talk about Trump and the administration wanting to increase oil production, but thus far, oil has basically stayed right in this level. Gold was the big winner. March up 7.9%. Remember, January was up over 7%. February is basically 1%. And now March up another almost 8%. It's up 16.4%. Why? Central bank buying and also geopolitical worries and, of course, possible inflation worries. Even though the economies may be slowing, worries about inflation. The dollar is down 3% versus the DXY index year to date. Volatility started at 1963. It closed at 1869. It did get up into the mid-20s and actually touched 30 at one point during the month before easing off a little bit. The GDP now forecast for the quarter that we've just ended, okay? That's the first quarter of this year. The GDP now forecast of the Atlanta Fed is right as of the end of the month, is looking for it to be down 1.8%. Why? Because of this flood of imports, not only of gold, but also of goods coming in, trying to anticipate and get in under the before the tariffs are imposed, and that led to large imports, which of course deduct from the GDP number. The next Federal Open Market Committee meeting will be May 6th, May 7th. We're expecting 87% chance of no change, okay? The first interest rate change by the Fed, and we're expecting right now a 25 basis point cut. That's a 63% chance of a 25 basis point cut. May, only 13% chance. You get into July, 79% chance of at least a 25 basis point cut, and maybe a 32% chance of it being down 50 basis points by that time. September 17th is the next meeting. There's no meeting in August, as you know. Expected the 92% chance of at least a 25 basis point cut and a 60% chance of at least 50 basis points. We're okay with 2 cuts this year. You're getting a couple of Fed officials talking about 1 cut this year, but we're okay right now with 2 cuts this year. The final 2 meetings of the Fed this year are October 29th and December the 10th. Let us just put all this into a portfolio context. We here believe that you need to have alternatives. We're good with private credit, where you can pick up yield. Make sure you're in the right place in the capital structure and quality-wise, and private equity, particularly the secondary market interests of private equity. With that, we wish everyone a great start to the second quarter of 2025. Thank you for being with us today.